Have you ever wondered why nearly 95% of retail traders completely destroy their accounts within the first few months, while a quiet minority uses the exact same charts to build absolute, unshakable time freedom? What if the problem isn't that the market is rigged, but that almost everything you've been taught about reading it is fundamentally backward? Let's be completely honest with each other right from the start. Most people who try their hand at Forex end up losing money. It's not because the market itself is some grand, elaborate scam. It's simply because almost nobody out there actually teaches it the right way. This is the exact beginner's blueprint to navigating the currency markets that I desperately wish someone had handed to me when I was first starting out. If you can truly digest the structural concepts I'm going to share with you today, you are instantly going to leapfrog ahead of the vast majority of retail participants. I've been navigating these volatile waters for 17 years now, and deciding to become a trader is easily one of the greatest choices I've ever made in my entire life. It didn't just give me financial confidence, it handed me the freedom to live life entirely on my own terms, and most importantly, it bought back my time to spend with my family. Now, look, I'm not here to flash ridiculous fabricated profit numbers on your screen, or insult your intelligence by trying to sell you some overnight getaway dream. Yes, the markets have been incredibly good to me over nearly 2 decades, but that's not the reason you should stick around to learn from me today. You should listen because of how I approach teaching. After spending more than 10 years fighting in the trenches of the live markets, I decided to build this channel. Since then, my team and I have spent years guiding struggling traders out of the cycle of losses and helping them finally unlock real, consistent results. So, if you are genuinely serious about learning this craft the right way, stay locked in. In this breakdown, I'm going to strip away the noise and give you everything you actually need to know to begin your Forex journey, starting at the absolute foundation, what this market actually is. Before we start diving into the incredibly exciting elements, the live trading strategies, the advanced chart setups, and the mechanics of extracting profit, we have to anchor ourselves in what you are physically buying and selling here. The traders who treat this part like boring homework and try to skip it are the exact same ones who end up trapped in constant frustration. At its absolute core, the Forex market is a giant global arena where currencies are bought and sold. When you look at the participants making up this network, you'll find retail traders like us operating right alongside massive commercial banks, hedge funds, and sovereign governments, all constantly exchanging one country's currency for another. That's the entire ecosystem. And here's a little secret. You have almost certainly already executed a Forex trade in your real life. If you've ever boarded a flight for a holiday, traveled abroad, or spent cash at a beachside bar in Europe, you had to physically trade your home currency for euros. As speculative traders, the way we extract profit from that exact same global mechanism is simple. Currencies are never traded in isolation. They are always locked in pairs. You are buying one specific currency while simultaneously selling the other in a single transaction, capitalizing on the microscopic fluctuations in the exchange rate between them. We find where prices are low, we buy, and we sell when they go high. That is the baseline game. When you open up a blank chart, the sheer number of available currency combinations can feel totally overwhelming. That's why my absolute highest recommendation for anyone starting out is to narrow your vision down to just 7 core pairs. These are known as the majors: EUR/USD, GBP/USD, AUD/USD, NZD/USD, USD/CAD, USD/CHF, and USD/JPY. Every single one of these pairs is anchored by the US dollar. Because the dollar represents the world's primary reserve economy, these pairs possess immense liquidity, meaning the transaction costs are tiny and it is incredibly easy to enter and exit positions fast. Let's quickly master the basic language of the pits. When you hear traders talk about bulls, they are talking about upward price velocity. When they talk about bears, they are talking about a downward slide. Therefore, if your analysis makes you bullish on an asset, you are actively hunting for high probability buy entries. If you are feeling bearish, you are looking to position yourself for a sell trade. The beautiful reality of this market is that you can generate profit whether the world economy is roaring upward or crashing down to the floor, provided your structural prediction is accurate. Where does this global exchange actually take place? It happens in what we call the spot market. Unlike a traditional stock exchange, which relies on a centralized physical building like the New York Stock Exchange, Forex operates as a completely decentralized global network of banks and institutional dealers, all tied together electronically. Because of this digital structure, we have the luxury of scanning for setups from anywhere on Earth, at any hour of the day. The market breathes continuously 24 hours a day, 5 days a week. The trading week officially kicks off when the opening bell rings in Australia. Then the volume rolls into Tokyo, followed by the massive influx of capital when London opens its doors, before New York finally steps in to close out the global loop. Personally, I focus almost all my trading energy inside the London and New York sessions. That is where the highest concentration of institutional volume lives. It perfectly matches my lifestyle. I get to hunt for setups briefly in the morning, execute my plan, and then completely step away to enjoy the rest of my day. To give you a sense of scale, this financial ocean is absolutely gargantuan, with roughly $8 trillion flowing through the network every single day. This massive scale creates pristine pockets of supply and demand, which form the literal bedrock of the advanced strategies I'm going to show you as we move forward. Now that you have a firm grasp on the underlying framework of the market, the next logical question is, how do you convert this knowledge into actual cash flow, and how far can you realistically scale this skill? Let's pull back the layers on the numbers. When you strip away all the hype and marketing noise, trading performance boils down to a very simple equation. Your raw technical skill multiplied by the size of your trading capital equals your net profit. But here is my warning to you. When you are starting out, I want you to completely banish the thought of profit from your mind. I want you entirely, obsessively focused on the mastery of execution. Growth in skill is the only metric that matters right now. Let's look at how financial returns actually scale across different account sizes. A modest, highly disciplined 5% return can look wildly different depending on the size of the bucket you are playing with. On a small account, that 5% might only net you $500, while on an institutional-sized account, that exact same percentage yield drops a cool $5,000 into your pocket. When you understand the math of compounding, the long-term reality gets incredibly exciting. Imagine a disciplined trader managing a $100,000 account who focuses on locking in a highly realistic, consistent 6% return per month. By the time they hit month 12, through the silent power of compounding gains, they haven't just made a little extra cash, they have effectively doubled their entire capital base, clearing over $100,000 in net profit. Now, the exact same mathematical principle applies to a smaller starting balance. Yes, the dollar amounts on your profit and loss statement will be smaller, but your goals at the beginning should match your experience. Don't try to get rich on day one. Ask yourself simpler, practical questions. Can this skill pay for your groceries every week? Can it clear a utility bill? That is the grounded, realistic mindset that keeps you alive in this game. I'm telling you this because I refuse to lie to you. 6% a month is far from a guaranteed paycheck. Every professional trader on earth, including myself, routinely goes through brutal losing streaks, periods of capital drawdown, and entire weeks where absolutely nothing seems to work. That isn't a sign of personal failure, that is simply the baseline cost of doing business. That is trading. If you want to transition from a casual hobbyist into a professional operator, you have to completely untrain the employee mindset. An employee trades an hour of time for a guaranteed unit of currency. A trader lives in a world of probability. A single bad month cannot be allowed to break your psychological capital. You have to focus on the macro scale, trusting your system across a 12-month horizon, reviewing your performance on a quarterly basis, and meticulously adjusting your risk parameters from there. My favorite aspect of this profession is that you don't need to hit astronomical home runs to live incredibly well. Consistently locking in even a total 20% return across an entire year is more than enough to build a remarkably comfortable life, or at the very least, remove financial anxiety from your household completely. When you boil the entire process down to its absolute essence, our sole objective is to buy low and sell high. We simply want to pinpoint exactly when a specific currency is fundamentally undervalued or overvalued so we can step in and exploit the market's correction. To do that, with high precision, we rely on two core pillars of market analysis: fundamental analysis and technical analysis. Fundamental analysis means diving deep into macroeconomics, tracking shifts in central bank interest rates, monitoring global inflation metrics, and digesting quarterly GDP numbers. But if I'm being completely transparent with you, almost 95% of my personal daily focus is dedicated entirely to technical analysis. That means staring directly at the raw charts, studying recurring human behavior patterns, mapping out structural probabilities, and reading order flow. I'm going to map out exactly how to do that right now. The way I see it, there are two distinct schools of thought when it comes to executing trades in the live market. First, you have the discretionary approach, which heavily relies on intuition, screen time experience, and trusting your gut feel when a setup begins to materialize. Then you have the mechanical approach. This is where you construct a rigid, objective system governed by explicit, unbreakable rules that must be met before a single dollar of risk is ever deployed. Personally, I heavily favor the mechanical methodology, both in my manual charting and when developing my automated trading software. Approaching the market through a mechanical lens strips the destructive human emotion out of the equation and keeps things remarkably clean. Finding a technical edge is only the first step. The true battlefield is execution. To build a sustainable trading business, you have to follow a strict four-step loop. Find a clear statistical edge in the data, rigorously backtest it across years of historical price action, execute it with flawless consistency in the live market, and once you prove the system works, aggressively scale your capital to let compounding do the heavy lifting. So let's break down the mechanics of technical analysis. At its core, it is simply the art of reading a raw price chart. We study historical data to decipher exactly why the market behaved the way it did in the past, and more importantly, to identify which institutional players are driving the current price action. If we can accurately map out high-probability future movements based on historical footprints, we unlock consistent profits. To do that, you must master the anatomy of a candlestick. Every single candle on your screen acts as a data snapshot, communicating 4 vital price points for a specific window of time: the open, the close, the high, and the low. On a bearish candle, which represents a drop in price, the session opens at the top of the real body and closes at the bottom. On a bullish candle, representing a rise, the price opens at the bottom of the body and closes at the top. The thin lines extending from the top and bottom are the wicks, mapping out the absolute highest and lowest extremes, the price reached before the session concluded. Don't panic if this sounds a bit abstract right now. We're going to pull up the live charts in just a second to look at it visually. Depending on the time frame you select, a single candle could compress an hour of intense market battle, or it could represent an entire day of global price action. But remember, candlesticks are just a visual simplification of order flow. Your real job is to understand the human psychology causing those shapes to form. Let's move right into the practical application. To do this properly, we use TradingView, a phenomenal, completely free charting platform that I use every single day. If you want to follow along, I've left a direct link for you in the description below. When you open it up, the interface presents a clean canvas. Over on the right-hand side, you can curate your master watch list of core currency pairs. Up at the top, you can seamlessly toggle between different time frames and layer indicators onto your workspace. Over on the left, you have access to drawing tools that allow you to map out major historical boundaries, like drawing a clean horizontal support level to track how price behaves when it tests a specific zone. Before I hand over the exact strategies, let's make sure we are looking at the candles with total clarity. When a candle closes lower than where it opened, it prints red, signaling a bearish session. When it closes higher than its open, it prints green, signaling a bullish move. The wicks tell us how far the buyers or sellers managed to push the price before losing control before the close. If you select a 4-hour time frame, every single individual bar on your screen represents a 4-hour block of time. If we use the chart replay tool to rewind time and look at a single historic 4-hour bar, you can clearly trace the story. The session opened here. Sellers violently drove it all the way, down to this bottom wick extreme. Buyers fought back to push it to the very peak of the top wick, and finally the session settled and closed right here. Mastering this visual narrative allows you to make dramatically better risk decisions in real time. Now let's dive straight into the strategies. I personally rely on 2 primary frameworks that have treated me incredibly well over the years: my core swing/day trading framework and my high-velocity scalping approach. We'll break down the day trading blueprint first, using a simple, highly effective 3-step sequence: identifying supply and demand zones, securing trend confirmation, and refining your exact entry mechanics. Let's unpack the day trading framework so you can see exactly how setups like this come together. While this approach shines on the hourly and daily charts for swing positions, the underlying logic is entirely fractional and works beautifully for short-term scalps as well. It is a foundational law of price action. Step 1 is all about mapping institutional supply and demand. What I am hunting for on a raw chart is a sudden, explosive, imbalanced push in price. Look at this section of the chart right here. 1, 2, 3. Consecutive giant green candles screaming upward. If we pull out our measuring tool and calculate the distance from the absolute floor of that move to the peak, it clocks in at a massive 75 pips. A sudden structural expansion of that magnitude doesn't happen because a few retail traders bought the dip from their bedrooms. A move that size requires upwards of $10 billion to $50 billion in net institutional order flow. That is the footprint of massive institutional entities stepping into the market. Because I want to trade alongside that institutional footprint, I want to map out that exact demand zone. To do that mechanically, I locate the final red bearish candle that printed right before the explosive upward surge occurred. I draw a horizontal zone tracking the real body of that candle. This box becomes my primary area of interest. If the largest banks and hedge funds in the world decided that this specific price level was an incredible value to buy, then I want to buy right alongside them if the price ever returns. Now, the vast majority of institutional transactions clear within the real bodies of the candles, which is why I prefer to map my zones from body open to body close. However, if the candle itself is quite small, I will cleanly include the wicks in my drawing because I refuse to miss a high probability entry over a couple of fractional pips. As this explosive move breaks away, I am immediately scanning the structure for fair value gaps. Look closely at the chart. We have a clear fair value gap resting right here and another one printed right above it. A fair value gap is simply a structural imbalance tracked across a 3-candle sequence. Let's isolate these 3 specific candles to see how it works. We have candle 1, candle 2, and candle 3. If you look at the upper wick of candle 1 and then look at the lower wick of candle 3, you will notice they do not touch. They leave a distinct open pocket of price action where only the real body of candle 2 exists. That open window is an imbalance. If the lower wick of candle 3 had dropped down to touch the high of candle 1, the price would be perfectly balanced. But because they left a glaring gap, it confirms that the buying pressure off our demand zone was so blindingly aggressive that sellers couldn't even pull the market back for a microsecond before the next bar opened. When I see multiple stacked fair value gaps tearing away from a demand zone, it tells me that the zone is incredibly potent and highly likely to hold as a powerful floor when price revisits it in the future. To add another layer of confirmation, I always scroll back to see how this zone fits into history. When we drag our demand box to the left, we can clearly see that this exact price level has a deep history of relevance. Price violently rejected off this floor in the past, carving out a beautiful double bottom pattern before launching into an identical rally. This gives us immense confidence that we are dealing with a structural line in the sand. Step 2 is securing our trend confirmation. We only want to deploy our capital in the direction of the dominant market flow. Let's map out the structural swing points on this chart. We have a clear swing low, which launches into a higher high, pulls back into a structured higher low, and then explodes into a brand new higher high. As long as the current corrective pullback does not violently breach or close beneath the previous validated swing low right here, our uptrend remains completely intact. Price might pull back to a minor demand zone halfway down, or it might slide all the way down to test the deep institutional demand block at the origin of the move. Either way, as long as that structural low holds, we are exclusively hunting for buy setups. The market isn't always perfectly clean, which is why you shouldn't overcomplicate your charts by zooming out so far back that the data turns into a chaotic blur. Keep your focus clean. Even when a chart looks slightly messy, you can easily trace whether the market is structurally maintaining a rhythm of higher highs and higher lows. For beginners who want an objective safety net to ensure they are on the right side of the trend, I highly recommend overlaying a 200-period exponential moving average, EMA, onto your screen. Go into the indicator settings, set the length to 200, and use it as a dynamic filter. If the price breaks aggressively above the 200 EMA and begins to print clean separation and distance from the line, you have immediate visual confirmation that the uptrend is highly viable. Marrying the 200 EMA with your structural supply and demand zones will dramatically boost your execution accuracy. Step 3 is entering the position. Let's look at how this trade plays out in real time. The market completes its rally and begins to slowly drift backward. I've already mapped my institutional demand zone using the wicks of that clean pivot candle, and I can see those beautiful fair value gaps resting just above it. The market has traveled roughly 62 pips away, so we know real institutional capital is anchored here. Now, I simply wait for the market to come home to my zone. When it comes to managing your risk parameters, your stop loss and take profit targets, you must remain highly objective. Looking at this specific structure, I look to the left and spot a major historical ceiling where the price failed to break through 3 separate times. That is an obvious line of resistance. Instead of being greedy and targeting some imaginary high far above the chart, I play it safe and place my take profit target right at that known resistance ceiling. Why risk giving back gains at a level the market has proven it struggles to cross? For my stop loss, I position it safely beneath the floor of the demand zone, and ideally just under the 200 EMA. This gives the trade plenty of room to breathe, knowing that the market will frequently sweep down to test the moving average as dynamic support before rocketing back up. There are two primary ways to physically enter this trade. If I watch the market approach my demand zone and notice a massive exhaustion of momentum where the red candles get small, tired, and slow down as they tap the line, I will place a limit order and enter the trade immediately the exact moment the price touches the top of my box, riding the clean reversal straight back up. Alternatively, if you want extra confirmation, you can wait for the price to tap the zone, watch for a strong green bullish candle to close out of the box, and enter manually right there. You'll get a slightly worse risk-to-reward ratio because you are entering later, but you gain the immense psychological peace of mind seeing that the demand floor is actively holding order flow. In this setup, the market taps our zone perfectly, prints a massive reaction, and surges straight through our take-profit target. Let's look at a complete end-to-end execution example to tie all these components together. Look at this trending structure: swing low, higher high, higher low, higher high. The market is screaming its directional intent. The 200 EMA is sitting beautifully beneath the price action, and even when the price briefly dips slightly under the moving average line, the broader market structure remains completely locked in an uptrend. I start scanning for my demand entries. I can see an older demand setup that would have cleared a beautiful win, a second one right above it that performed flawlessly, and then look at this fresh explosive launch right here. This sudden surge maps out a brand new institutional demand zone. I construct my trade plan. My stop loss goes right below the structural floor of the demand zone, and my take profit target is locked directly at the absolute peak of the recent swing high. We trigger the entry. Once the price action actively pumps past the midway point of the move, I can choose to slide my stop loss up to my entry price to guarantee a completely risk-free trade, or even secure partial profits at the first minor trouble area. These are advanced trade management mechanics that I break down extensively in my other videos, but as you can see on this chart, the demand zone holds perfectly, triggering an explosive institutional rally that clears another massive win. I have built my entire career on this exact methodology for over a decade. Now that you have the swing and day trading approach down, let's transition into my fast-paced scalping framework. Scalping is an entirely different beast. It takes place on tiny time frames, demands intense concentration, and delivers rapid-fire action. To keep from getting overwhelmed by the speed, we break it down using a strict three-step opening range protocol. Our strategy centers on the opening range breakout, ORB. While you can technically hunt for breakouts throughout the day, the absolute golden window for this strategy is exactly at 9:30 a.m. Eastern Standard Time, the official opening bell of the New York Stock Exchange. Now, what are we waiting for? We are waiting for a candle to violently break outside of that box and close. Look at this chart. We get a minor break below the floor, but it's weak and immediately pulls back inside. The move I am truly hunting for is an aggressive, dominant break, and close above the ceiling, a concept we call displacement. Displacement means the market isn't just drifting out of the box, it is tearing away with massive institutional velocity. This explosive candle leaves behind a fresh demand zone and a prominent fair value gap right at the break line, proving that massive buyers have hijacked the morning session. But before we blindly click buy, we must trigger step 2, trend confirmation. We look back at the broader structure to ensure we are trading in line with the dominant trend. We can see our structural lows are steadily moving higher, the price is trading beautifully above the 200 EMA, and the market has just retested the moving average before exploding through the morning range. We are in a confirmed high probability uptrend. As long as price doesn't violate our macro swing low, we are strictly looking for buy entries. Because scalping is incredibly fast, you need as many overlapping reasons or confluences as possible. If you don't use strict filters, scalping will blow up a trading account faster than almost anything else in this game. You have to be incredibly disciplined. In fact, because this strategy requires such precise execution speed, I actually ended up coding this exact mechanical protocol into a fully automated trading robot. I released it to our community about 7 months ago, and if you step into our Discord server, you can see hundreds of our members posting their daily verification statements, traders securing consistent winning streaks day after day using the software. If you want to see the real-world performance metrics for yourself, the direct link to our Discord is right down in the description. Once our morning range is set and we have verified our trend confirmation and institutional displacement, we move directly to step 3, executing the entry. The moment that aggressive breakout candle closes, we map out our entry order right at the exact top of the morning range boundary. we are setting our net right at the breakout ceiling, waiting for the market to perform a brief micro pullback to retest that line before continuing its run. For our profit target, we look at the historical data to find the nearest overhead resistance level where the price stalled out in the past, and we place our take profit right there. For our stop loss, we place it safely beneath the bottom of the morning range or below the 200 EMA, depending on the structure. In this live example, the market dips down, fills our entry order at the top of the range perfectly, and instantly shoots skyward to smash our take profit target. Look, the market isn't a magical ATM. There will absolutely be mornings where the price hits your entry level and goes straight through your stop loss. Dealing with losing trades is simply part of the professional reality of this business. But equipped with these two distinct structural frameworks, my institutional supply/demand day trading approach and my mechanical opening range scalping system, you have everything you need to safely step into the market. Start slow. Open a demo account, use TradingView's replay mode to practice rewinding the charts, and backtest these rules over past data until your execution becomes entirely automatic. If this breakdown brought massive clarity to your charting journey, hit that like button, subscribe to the channel, and come hang out in our trading rooms. I'll be back next week with another masterclass. Much love, trade safe.